Thank the central bank for fueling gold to run, says Aakash Doshi. He is North America Head of Commodities Research at Citi. Aakash, welcome to Kitco.
Thank you for having me on.
Now, Aakash, gold has hit several all-time highs this year, but the U.S. dollar is strong. Yields are up, which should be weighing on gold. What's going on?
I think it's a combination of strong physical demand that financial is just catching up to. You mentioned the central bank story at the beginning of this segment. The first quarter of 2024 saw a record amount of purchases, just over 290 tons. That's an all-time seasonal and quarterly record. On top of that, though, you've also seen very strong Chinese buying, non-monetary imports. So thinking about China retail imports that don't include the PBOC were at an all-time high in the first quarter as well, outright and seasonally, around 565 tons. So we think that physical demand pool has been very robust this year. It's been quite strong, and financial flows are just simply catching up to the fact that gold demand curve has shifted outwards.
Let's break those apart. Let's start with the central banks first. One thing I just want to step back is that central banks, the buying, it can really be quite sizable. If it actually steps up, it could actually rival jewelries. And I think you made a note of.
That's right. If you think about historically the gold supply demand model, the demand side of the ledger has been driven and led by jewelry demand. Consumption could be as high as 50 or 55% for gold jewelry, historically speaking. But that's started to shift over the last 10, 15 years. Really, it started with the great financial crisis. So for 4 decades prior to the GFC, following the Nixon shock, central banks were net sellers of gold. They provided net supply to the market. After the GFC period, you saw central banks emerge as net buyers. And initially it was 2, 3, even 400 tons per annum. But those numbers started to increase first in 2014 with US sanctions on Russia with the annexation of Crimea, again in 2018 amid the US Sino trade spat, and then finally, again, after 2022, following the Russia-Ukraine war. To put that number into context, central banks are now consuming over 1,000 tons per annum. This is supply being taken out of the market. And from a mine production standpoint, that now represents somewhere around 25 to 27, even 28% of annual mine production. So central banks are really absorbing a lot of physical in this market. And it probably is part of a multi-year structural trend, dare I say.
How broadly based is the central bank buying? There's some. You look at there's close to 200 countries around the world right now, and looking at countries that are actually buying.
So it is primarily focused on emerging market central banks and the official sector there. So you think of Russia, you think of China. Those have been the two largest buyers over the last decade. But the central bank and official sector demand impulse for gold has spread beyond just those two sovereigns. If you think about it, India, Brazil, Poland, Thailand, Turkey, these have all been large buyers of gold for reserve management and for official sector purposes. On top of that, in recent years, post-pandemic, you've actually even seen developed market Asia get involved with the gold story, with the official sector in Japan and most notably Singapore among the top buyers of gold for central bank reserves over the last couple of years since 2021. And I think that's interesting because they're not traditional emerging markets, and in Japan's case, they're a G3 central bank even.
Let's talk about China. You've noticed that there's been an uptick in buying cash?
Yes, it does look like there is strong demand pull from China this year. Actually, it started even a year ago because imports were very strong in the first half of 2023 before the PBOC clamped down with some bank import license restrictions. But yes, the buying impulse in China has been very strong, particularly into Lunar New Year this year. We think it's a combination of factors that are driving that. One, it's just pent up retail demand post-COVID within China and within the mainland and onshore. Two, it could be some combination of CNY and currency hedging, right? Or whether it's to hedge weaker property market or equity onshore, and gold is a good investment vehicle in that regard for Chinese investors. And a third factor could be even some shadow imports. Non-monetary gold imports have surged this year. Maybe some of that is even for the official sector, though it's tough to disentangle.
Now, Cash, what happens when the gold price runs up is that you see that jewelry starts to fall off, which will end up kind of softening how high that gold prices can go. You'll either see more recycling, you'll see a switch out to other types of precious metals in the jewelry space, which we're talking before is about 50% of demand. Sticking with the central banks in China, do you think that prices are somehow also going to be able to soften demand, or do you think that the central banks in China are looking at gold a little bit differently and a little bit more strategically in terms of their aims?
I think it's fair to say that the central bank demand impulse and overall official sector demand impulse for gold, so including sovereign wealth funds, treasury departments, governments, in addition to central banks, we think that is more strategic in nature, meaning they should be among the most price inelastic buyers. Not saying that price doesn't matter at all. Certainly, if you're battling a recession something like the COVID shock in 2020, you could see central bank demand pull weaken. But the overall uptrend seems driven by several factors, whether it's a broader de-dollarization theme, whether it's for reserve diversification purposes, whether it's just demand for bearer assets, right? Gold in physical form has no credit risk, and also just to maintain holdings in another liquid asset of which gold is.
Now, Cash, Kitco talks to a lot of people that are gold inclined, and one of the main themes that runs through this is debt worries, and it's just because that we're adding more debt. There's going to be concern about servicing that debt, especially in the U.S. Well, I guess all Western countries, and that's a driver for gold going higher. Given your rationale that you're talking about, you've talked about the central banks, you talked about de-dollarization, you talked about diversification, but how do you see that theme going through in terms of debt worries, or is that something that would be more, how would you say, an inclination on the retail side?
I think that's a fair point. It's something I've highlighted for months, and I'm glad you brought it up. Alternative fiat demand for gold should be robust. It is a driving force, we think, behind the recent gold price move in 2024. Where do you come up with that? It's Akash, hey, debt is always rising, just like population growth. Global debt is always on the rise. I think it's the pace and scale of the rise in debt that really is mattering here. So if we look from the start of the pandemic at the beginning of 2020, and we go through the end of 2023, in those 4 years alone, we've seen global debt, public and private, grow 22 to 25% to a record 315 trillion notional. That number is obviously set to expand in the decades to come. And we do think the pace of that increase has probably driven some more demand for alternative fiat, including gold. We think some of that might be driving the central bank story. And more interestingly, on the consumer side, it's probably driving bar and coin demand. Because actually, you can see if you break down the growth of the demand side of the ledger, jewelry is the most important component, as you had mentioned earlier in this segment, but that has actually recovered more weakly post-pandemic and post-2020. What's actually surprised to the upside, what's actually been at a stronger trend demand growth has been bar and coin demand. And we've seen this from private bank. We've seen this from ultra high net worth investors. We've even seen this from retail consumers. We've all seen the anecdotes of Costco selling out of gold bar and coins. Well, that's a little bit of a global phenomenon as well. Bar and coin demand has been quite robust since the global pandemic. And we think that reflects some of that alternative fiat demand. You can see that in related markets such as crypto earlier this year as well.
Where are we with gold ETFs?
So gold ETFs is an interesting story because they've actually been providing physical supply to the market. Holdings peaked in the fourth quarter of 2020, early during that quarter. And really, you've been on a structurally unwinding trend for the last several years. back of the envelope off the top of my head, I think you're looking at something like 25 to 30 tons of net redemptions per month on average since the fourth quarter of 2020. You've seen brief periods of inflows during the US regional banking crisis in last spring, but generally they've been selling. What's interesting is I think the physical demand pull is so strong from bar and coin, is so strong from central banks and the official sector that those ETF unwinds in the local London market are being more than absorbed by other physical off takers. And I think in that context, what's also interesting on the gold ETF side is yes, they've been selling, yes, shares have been redeemed. But given the price rise, AUM has been relatively steady, or assets under management. So, from an allocation standpoint, at least, we're not seeing a decline necessarily in holdings. But yes, ETFs have been a source of supply in the market, perhaps taking advantage of high prices and perhaps a transfer of some of the ETF physical into other sectors of demand for gold.
Let's talk about Bitcoin and how that plays into gold, Aakash. Now, there's a lot of people that have been saying that Bitcoin rise has come at the expense of gold. Others are saying that it is broadening interest in fiat alternatives. Also, maybe talk about if Bitcoin is an alternative for central banks, or if they're actually being gold is the only way to go for them.
Look, I think at Citi Research, we don't view Bitcoin as digital gold. We view it as a separate asset market, probably more closely tied to technology stocks and given network effects and other factors that are driving that growth. This year in particular, ETF launches and approvals by the SEC to launch several new products US onshore. Broadly speaking, historically, we have not seen much of an impact on crypto either adding or taking away from gold demand. We see different buyers and sources of gold consumption that are separate from crypto and vice versa. Now, of course, there is overlap, and some of it is the alternative fiat story. Some of it is the bearer asset story, gold in physical form, arguably crypto in digital form. But to that extent, we think gold is moving on some independent drivers. And I would add that the official sector and central bank gold demand story is unique in the sense that gold is historic and old money. And the fact that the central banks themselves are stockpiling gold and using it part of their foreign exchange reserves, it's literally accepted by every central bank, and all major central banks holds some of their reserves in gold. It kind of justifies gold as part of the monetary system already. So it's a little bit more of a traditional old money, hard money asset. So I think some of those drivers are moving independently as well.
Akash, do you know when we can go and then we can say that gold has safely and potentially set at a new base, say around 1900 or 2000? I just asked because I know that would make a lot of miners happy, Akash.
Yeah, that's a great point. I think we at Citi, myself, I had outlined in my note targeting topside for gold that we probably are in a period of a higher price floor. And I do think that 1850, 1900 to even $2,000 an ounce could be a new re-rating higher for the gold market. And that would be well above the cash cost curve for gold. That being said, miners for gold have experienced a lot of inflation since the pandemic. If you look since 2020, gold cost inflation has increased more than your typical commodity over the last 3-4 years. That has made it more expensive to mine the yellow metal. A lot of factors driving that. But yes, do I think 1900, 2000 could be a new soft floor? Yes. In the same way, $1,000 an ounce became a floor price for gold following the great financial crisis, we may now be in a period where nominal prices have a new price floor. Some of it aided by higher all-in sustaining cash cost curves, some of it driven by the central bank demand pull that is kind of soaping up a lot of this physical. Some of it could be related to the alt fiat, China demand story. So a lot of factors going into that. But yes, I do think it's fair to say that we're in a higher for longer regime certainly over the medium term.
Lastly, Akash, on de-dollarization, how do you link gold to some countries wanting to ease away from the world's reserve currency?
It's part of a long-term strategic pull, it seems. And certainly you mentioned China earlier. Yeah, that seems to be a part of it, going back to BRI or Belt and Road Initiative onwards. And to that end, it suggests that this is probably a multi-year, multi-decade demand pull for gold. And that doesn't mean that the dollar is going away. Of course not. The dollar has rallied, like you mentioned at the beginning of this segment, amid this gold price rally. In fact, gold has outperformed across the rest of G10FX and most of EMFX versus in dollar terms over the last 6-8 weeks since the beginning of March 2024, even though gold is up in dollar terms as well. So I think from that standpoint, it's about reserve diversification. It's a reaction to perhaps U.S. sanctions policy and the perceived weaponization of the U.S. dollar by some central banks and some economies. And then I think it's part of a broader trend of just diversifying reserve assets, of which gold has historically been a part, certainly before the Nixon shock and post-Bretton Woods system in the early 1970s and before that, and also just historically, given the gold's role as old money, right? It's from biblical times to fiction and Game of Thrones to how wealth has been described by Shakespeare and novelists throughout history. Gold has always been seen as that store of value, and I think that's a component that translates not only through lore and mystique, but also to what policymakers, central banks, and financial reserve managers think as well.
Cash, thanks for your time.
It's a pleasure. Thank you for having me on again.
My name's Michael McRae. You're watching Kitco Mining.